Take out your credit card. Look at the interest rate on the back. The average right now in America is 29%. Now I want you to do some math with me. If you carry a $5,000 balance, the average American credit card debt, and you make only the minimum payment every month, here is how long it will take you to pay it off. 32 years. And here is how much you will pay in total. $14,423 for $5,000 of debt. That math is not a mistake. That math is not a bug. That math is the product. What you are about to hear is documented in congressional testimony, in internal bank memoranda released through litigation, and in the findings of federal regulators who were systematically prevented from doing their jobs. The minimum payment was not always a thing. Before the 1980s, most credit cards required customers to pay their full balance every month. They were charge cards. You spent, you paid. That was it. Then something changed. In 1987, Citibank, at the time the largest credit card issuer in America, made a quiet decision that would reshape the personal finances of every American alive today. They reduced the minimum payment requirement from 5% of the balance to 2%. That sounds like a gift. You pay less each month. Who wouldn't want that? But here is what that decision actually did. At 5% minimum payment on $5,000, you pay off your debt in 7 years. Total interest paid, $2,100. At 2% minimum payment on $5,000, you pay off your debt in 32 years. Total interest paid, $9,423. By dropping the minimum payment by 3 percentage points, Citibank increased the interest you would pay by 449%. And within 18 months, every major credit card issuer in America had adopted the same 2% minimum. Because it worked. 5% minimum, paid off in 7 years. $2,100 interest. 2% minimum, paid off in 32 years. $9,423 interest. But the minimum payment formula is only the foundation of the trap. There are 17 more layers on top of it. And they all have one thing in common. They were designed by people with PhDs in mathematics, specifically to maximize the amount of money you pay before you get out of debt. In 2007, a former senior executive at a major credit card company testified before the Senate Banking Committee. His name was Samuel Carlisle. He had spent 14 years designing what the industry calls product optimization. He said, under oath, "Our entire pricing architecture was built around one fundamental insight. The longer a customer carries a balance, the more profitable they are to us. Every feature of the product was designed to extend that carrying period for as long as legally possible." Late fee, up to $41 per incident. Over-limit fee, up to $39 per incident. Foreign transaction fee, 3%. Every single purchase. Cash advance fee, 5%, plus a separate APR of 29.99%. Balance transfer fee, 3 to 5% of everything you move. Annual fee, $0 to $695 per year. Returned payment fee, up to $41. Statement copy fee, $5 to $10 per page. Expedited payment fee, $10 to $39 to pay them faster. Paper statement fee, $5 to $10 per month. That last one is worth repeating. Some banks charge you a fee for receiving a document that shows you how much money you owe them. The Consumer Financial Protection Bureau, the federal agency created specifically to protect Americans from predatory financial practices, estimated in 2023 that credit card companies collect approximately $25 billion per year in late fees alone. $25 billion per year in late fees alone. The CFPB proposed a rule in 2023 that would cap late fees at $8. The credit card industry spent $500 million lobbying against that rule over the following 18 months. The rule was blocked by a federal court in a ruling that legal scholars described as highly unusual given the agency's statutory mandate. The judge who blocked it had previously worked for a law firm that represented major credit card companies. He was not required to recuse himself. CFPB proposed $8 late fee cap, 2023, industry lobbying against it, $500 million. Rule blocked. Judge, former credit industry attorney, $25 billion in late fees. $500 million to protect that revenue. The return on that investment, 4,900%. In 2023, the Senate Banking Committee held a hearing on credit card marketing practices. One of the witnesses was a 26-year-old woman named Ava Reyes from Phoenix, Arizona. She had received her first credit card offer during freshman orientation at Arizona State University in 2019. She was 18 years old. She had no income. She had no credit history. She had no financial education. The card she was offered had a $2,000 limit and a 27.99% APR. She testified, "The booth was set up right next to the bookstore. They were giving away free pizza. I filled out the application because everyone else around me was doing it. The whole process took about 4 minutes. No one explained what APR meant. No one told me what would happen if I only paid the minimum. I was 18 years old, and I had just been handed the most expensive financial product most Americans ever use in about the same time it takes to order lunch." Ava graduated with $3,800 in credit card debt, in addition to her student loans. She is still paying it off. She's not an unusual case. According to data from Sallie Mae, 57% of college students have a credit card. The average balance, $1,900. The average APR on student-targeted cards, 24.6%. And here is the detail that should stop you cold. Under the Card Act of 2009, the landmark consumer protection legislation that was supposed to fix all of this, card issuers are prohibited from issuing cards to anyone under 21 without proof of income or a cosigner. But they are still allowed to market on college campuses. They are still allowed to collect applications from students who do have income, including students whose only income is a federal financial aid disbursement. Financial aid. Money given by the government to help students pay for college, being used as documented income to qualify for a high-interest credit card. Card Act 2009. No cards for under 21 without income. Loophole. Financial aid counts as income. $1,900. Average student credit card balance, 24.6%. Average APR on student-targeted cards. Here is the question I want you to sit with. If a product was designed by mathematicians to maximize the time you spend in debt, and companies spent $500 million to make sure the law couldn't touch them, at what point does a financial product become something else? Now I want to talk about credit scores, because the credit score system is the most elegant part of the trap. Your credit score, the 3-digit number that determines whether you can rent an apartment, get a mortgage, or in some states even get a job, is calculated by a private company called FICO. FICO is not a government agency. FICO is not a public utility. FICO is a private corporation whose primary customers are the credit card companies and banks who pay to access your score. Let's talk about what FICO rewards. FICO rewards carrying a balance, not carrying no balance, carrying a balance. The credit utilization component of your score, which accounts for 30% of your total score, rewards you for using between 10 and 30% of your available credit. 0% utilization, your score goes down. Carrying a small balance, your score goes up. This is not an accident. This is a system designed by people who profit when you carry a balance, rewarding you with a higher score when you carry a balance. The conflict of interest is structural. It is not hidden. It is just not discussed. And then there's the hard inquiry system. Every time you apply for credit, a hard inquiry is placed on your report. Each hard inquiry drops your score by 5 to 10 points. This means if you are shopping for the best interest rate, doing exactly what every financial advisor tells you to do, the act of comparing rates damages your credit score. The consumer behavior that would save you money is penalized by the system that controls whether you can borrow money. 3 companies control your credit report: Equifax, Experian, TransUnion. In 2017, Equifax, through negligence described by a congressional investigation as entirely preventable, exposed the Social Security numbers, birth dates, and financial information of 147 million Americans, nearly half the United States adult population. Equifax's response? They offered 1 year of free credit monitoring through their own service, which costs $19.99 a month after the free year ends. I want to give you the information they don't put on the application. 1. The number on your statement labeled minimum payment due is not a suggestion for how to manage your debt. It is a calculation designed to maximize the amount of interest you pay over your lifetime. Pay more than the minimum. Always. 2. You can call your credit card company and ask them to lower your interest rate. This works more often than you think. 40% of cardholders who call receive a rate reduction on the first call. The average reduction, 6 percentage points. The script: I've been a customer for X years. I have a strong payment history, and I'd like to request a rate reduction. If you can't help me, I may need to transfer my balance. 3. The balance transfer offers that come in your mail, the ones advertising 0% APR for 18 months, are mathematically useful if you read the fine print. The transfer fee is typically 3 to 5%. Calculate whether the fee is less than the interest you'd pay staying put. Often it is. 4. Freezing your credit. Not a credit lock. A freeze is free by federal law at all 3 bureaus. It prevents anyone from opening new credit in your name. You can thaw it temporarily when you need it. Equifax.com, Experian.com, TransUnion.com. Free. Permanent until you lift it. 5. If you have significant credit card debt, a nonprofit credit counseling agency can negotiate directly with your creditors. The National Foundation for Credit Counseling offers free consultations. NFCC.org. Not a debt settlement company. Those are different and often predatory. a non-profit counselor. The credit card industry in America generates approximately $180 billion in revenue per year. Approximately $130 billion of that revenue, 72%, comes from interest payments and fees paid by consumers who carry a balance. Not from merchants, not from annual fees on premium cards, from people who couldn't pay off their balance. The business model is not provide a convenient payment service. The business model is get you to carry a balance and keep you carrying it for as long as possible. Everything else, the rewards programs, the airline miles, the cashback, the sleek metal cards, and the prestige partnerships, is marketing designed to acquire customers who will eventually carry balances. The rewards card is not designed for the person who pays in full every month. The rewards card is designed to normalize the idea that credit cards are aspirational objects worth having for their own sake, so that more people get them, and some percentage of those people will eventually carry a balance. The people who pay in full every month are called deadbeats inside the industry because they use the product without generating the revenue the product was designed to produce. I want to leave you with one number. The 5 largest credit card companies in America, JP Morgan Chase, Citibank, American Express, Capital One, and Bank of America, together spent $2.3 billion on advertising last year. $2.3 billion to tell you how much they value you, how much they want to reward you, how much having their card will improve your life, and $500 million lobbying Congress to make sure the rules stayed exactly the way they are. Subscribe to Dark Mind. New documented case every Tuesday. Leave a comment with one thing you learned in this video that you wish you'd known sooner. I'll see you in the dark.